Hello. How do you do your swing trading daily chart analysis of upward large cap stocks if you are using long option swing trading strategy? You'll open your chart, your daily chart, either maximum daily chart, which we have open, or 1 year daily chart nonetheless. Just make sure you use one that you can see your trend lines, and I like maximum daily chart for long option line swing trading strategy because some of our trend lines are low, and if the stocks is in touch base with the trend line within 1 year time frame, you may not see that trend line on the 1 year daily chart if the price is further up. So it's good to have your watch list of stocks that you like to swing trade. And for long option and swing trading strategy, I find upward stocks to be a good one to work with that strategy. Here we have upward large cap stocks, and the first one we are going to analyze, three in this video. The first one is Google. So I'm going to tap Google symbol, and we have two trend lines to buy Google at. And yesterday the price went down. So let's zoom. Okay, the price pulled back, and since it's at the trend line, we are going to pay close attention to it. So it was doing lower lows and touch base with the trend line, went up and pulled back. So if I compare this pullback to this one, the red bar are the pullback. So if I compare the bottom to this one, I have a higher low here. So if I connect them, it will be a downward trend that I will trace. Let me turn this into a trend, so that a line, so that it does not put arrows all over. But yeah, and a red bar means yesterday when the market was open, and yesterday was March 10, 2025, the price at the end of the day was lower than the price in the morning when the market's open. And a green bar means the price at the end of the day when the market closed was higher than the price in the morning when the market's open. So the price went up that day, that was green bar, and the price went down yesterday, interpreted by a red bar here. So now we have a downward again. So we are just going to keep observing it to see what is going to continue doing. So we are thinking that it's going to go up from here. We have this one line because it does wide mountain, but I'm just thinking maybe it may not come back to this. It might continue from there, because for the past year or so, it touched base with this trend line in March, in June. Yeah, this is March as well, and this is June. No, this is September, and now we are in March. It touched base with it again, and around here was January. Yeah, March. So it seems like it pulls back to touch base with the trend line in March and go up from there. So yeah, we are thinking about buying it around that trend line. Unless it continue going down, then we can wait for that to touch base with this, but we'll keep observing it. And if we'll buy around here, we'll want to see that start making higher lows. So while we are at that trend line, let's compare how it does at that trend line when it reaches it. So if I look at this one, when it touch base with it, it start going up from there. So that's what I will have. Imagine it does here, and it touch base with it around earning time. So we'll see. One thing, even though we do not have, I'm going to break our rule here. So that's pretty much to just point out that, you set the rules and you see how does that apply to stocks that you are trading. So before around your entry point and around your exit point where you want to sell, when you are close to those areas, compare how the price moves around those areas in the past. So by comparing this, we notice that when it pulled back to it just went up, pulled back a little bit, but it pulled back to it around earning time there. So it's not an earning but dividend payment or so. So it came to it before this dividend payment happened and start going up and pull back again right on the date of the dividend earning or so. So if I wanted to compare it to this, is from here it could start going up. So I could take the risk and buy today. If I see a green bar today, that is pretty much around that area, with the assumption that it could continue going up, pull back, go up, pull back, but now continue going down. Or I could wait for that to go up, and when it pull back like green bars and start going up, that's the rule that we said, the first green or the second green bar that follow a pullback, we can get in, and that will make us, I'm looking at the price 146, it'll be easily over $10 difference in share there. So I could take the risk and get in by not following the rule that I said, but comparing how it behaves around that. So when we come back here, the last time it touched base with it again here, when it touched base with it, it went up, pull back a little bit, and just go from there. So if we continue going a little bit here to see another option, it will be this one. This one didn't really touch base with this here, but again it continue going up from there. So continue, and we come down here. Okay, it pull back shortly in here, there is no, but after this earning, but pull back, went up and go from there, but then came back a little bit here, pretty much start doing those zigzag. Let me see the price here and the price here. Yeah, this is a little bit higher here, but and start going up, but came back few times though around that area. So but yeah, we could still stick to our rules and not buy it right at the trend line, but wait for that to start making higher lows before we get in. Or we can just take the risk and get in. If it turn out to be too early of an entry, that will be okay as well. We are talking about Google. It's not going anywhere anytime soon. So do you see how we did that analysis? Every stocks will behave differently, and once you start trading that stock, you can be flexible with the rule you set to apply, because you'll get to understand the pattern of that stock. And swing trading stocks you can invest in long term. Well, If you got in too early, you just get stuck in it and leave it in your portfolio negative until the price continue to go up, and then you can sell it for a profit. So that's how, when a stock is close to your entry point, you're supposed to analyze the situation, see if you're having a higher lows, an indication that the stocks is down, going down, for you to buy at the first or second green bar that follow pullback. Like when you have about 2 higher lows or so. But and then at the same time you compare how the price move around that trend line in the past to see if it actually changed direction multiple times before start going up, or if it touch base with it and start going up and pulling back on the same, going in the same direction. You see those red bar is going up, pull back, but didn't really change direction, still going upward. But yeah, but when you see here it changed direction here, but it actually go down before going up. So those things can happen at the trend line, and you can, see every stock behaves differently. So comparing those, and so that is Google. We are going to just keep an eye on it. And today, if we have a green bar, we can debate whether we want to buy some share to see if it's going to continue going up from there. If it turn out to continue going down, well, when it gets here, maybe we might buy some more. Okay, so the next one we are going to analyze is going to be GWW. And GWW, we bought it already, that's why we have it highlighted, but we have it in blue because maybe we are thinking about buying some more if necessary. But yeah, so GWW, yesterday the price went up, that's why we have a green. The closing price is highlighted in green. So we bought it there in 2025. So pretty much the rule we say is, you see it touched base with the trend line, went up, pull back, went up, pull back, went up, pull back. So we have few upward, a few higher lows that make an uptrend there at the trend line, and we buy and we bought it. But guess what? It pulled back again. You see, it pulled back down and below the trend line and start going up. So I was thinking about buying some more if it touched base with this trend line here, but clearly it didn't touch base with it, because we bought it somewhere here. The price is like 1,140, 1,114 or so, and now is around 1,015, 1,100. So about $100 difference in a share. That's why I was thinking, well, if we fall back down here, we might buy some more. But clearly it pulled back, didn't touch base with it and start going up. So we are not going to, it's 3 days in already, we are not going to buy anything. We'll just keep observing it to see if it's going to continue going up from here, or if it's going to, continue touching base with it here. But we apply the rule here, you see, just to make sure it's down, going down, because when it's going down, it's going to make lower lows. So seeing higher lows give us an indication that it's down, going down. We bought it, but still it turned around to go back down for a while and start going up. So we don't know if it's going to continue going up from here, if it's down, going down, or if it's going to, continue to touch base with this or not. So it's an early entry, even though we apply the rule here. So the rule is not like 100% proof that it will allow you to get in right on time. And we traded this one few times in 2024 using short option long swing trading strategy. Arrows at the bottom shows where we bought, and arrows at the top shows where we sold. So we bought it there, it pulled back on us for a while, we kept it, and we sold it here. So pretty much months later, we bought it again here, and it pulled back on us. So we bought it in January, and pretty much more than a month ago. But yeah, so we'll just keep observing it. So the last one that we are going to analyze in this video is ICE. ICE, if I go back to GWW, if I didn't purchase it there and I'm tracking it to purchase it using long option long swing trading strategy, for what it's doing right now, I won't buy either because it's making lower lows. If you compare those red bar that are delimited by the green bars, you're comparing the last in each session, there is like downward. Does that make sense? So we want to start seeing higher lows the way we started here to know that it's down, going down. Otherwise there is a chance it will continue going down to touch base with this. So if we didn't buy it here, we are not going to see any entry point just yet because it's still going down in some way. So if this is going to be the end of it, we want to start seeing red bar that will be higher than the previous one, since the red bar are what we are calling the pullbacks. So it's not the entry point yet around this area. So I won't advise anyone to buy at this point. Just, you know, if it's going to continue going down to go here, we don't know. So we'll just keep observing it. So then the last one we'll analyze in this video is one ICE. So ICE, we have this trend line to buy at, but right now is higher up, and yesterday the price went down. You can see the closing price was highlighted in red. If I can pull my standard line here, so but it has no way to go there, and right now is following this trend line, this short up trend line here. So but we are observing it before, tracing that resistance line to see if it's going to rest on it. It rests on it and went back up from there. So it's not done going up, but yeah, it's like $20 difference here. But yeah, since I don't really use resistance line to target my as my entry point, I use support lines for entry point unless they both connect at some area to provide a support, a strong support. I usually don't use it. But I will keep an eye on the previous resistance line to see if that will have an impact. And here it did. It pulled back to that previous resistance line or peak of that mountain level, rest there, and just went up. Okay, and just went up from there. So, and let's go back to GWW. So let's assume we already bought GWW. Using long option long swing trading strategy, when you are analyzing your chart on a daily basis, you'll compare where the price is right now, like how it performed during the day when the market was open, because you'll do your chart analysis at the end of the day after the market closes or early in the morning before the market opens. So you'll compare, you'll see where you enter the trade. You will see where we bought is where we put the arrow. So you will see where the price is now. You will see where you want to sell, which is our exit point with upward a large cap stocks, they reach new high often or frequently. Therefore, the next high is our target point, especially buying it at the trend line. So therefore, we'll just be comparing where the price is to where we want it to sell, which will be a new high. It will pass this peak here, and when it got close to it, then we'll be comparing the previous peak, how it behaved. So when it reached that peak, it pulled back. When it went back up, it pulled back. But then leaving the trend line, it reached the peak multiple times, you see. So since we are buying it at the trend line, if we keep this one, if it comes back here, we buy it again. So buying it at the trend line, when it reaches the first high, we may not sell it, because again, history shows us that it can reach that high, pull back, go back up, reach another one, pull back, go back up, reach another one, pull back, and so forth. So it might do it like 3 times or so. So when it reaches the first high, we can stay in it, wait for the second one, and after the second one, why not? We can get out. Here it did it 3 times as well. So if it reach the high twice, we can get out and just wait to get back in again. We don't need to wait for the third one necessarily. If the third one does not happen and decided to pull back, then we might lose a chunk of our profit. So it's just better when we see a high twice, we get out. Again, because of this, how the price move in the past can give us that assumption. Otherwise, the first high we can get out, but we could have 3 new highs before it will pull back to the trend line again. So we might lock 2 in and let the other one go. It's not about making the maximum profit. It's not about being the best swing trader. It's just about making some profit and lock some profits in, instead of investing in long term and let our money grow along the support line. We can swing through the cash flowing those fluctuation away from the trend line, away from the support line, cashing them in, even if that means buying it at the trend line at a higher price. Since the trend line is upward, the price here is going to be higher than the price here, and so forth. But the profit we lock in will allow us to offset that higher price, you know. But yeah, cash flow those in stocks that we could have let our money grow in it, steadily at the support line, cash flow in it, locking in those fluctuation away from the trend line. And that is pretty much, in my opinion, what swing trading is about. If you are swing trading stocks that you could have invest in long term otherwise. Thank you so much for watching. We thank you very much for your time. We thank you very much for watching our videos, and we thank you very much you all that subscribe to our channel. I'm Afiavi Liberman, creator of Liberman Consulting L.L.C YouTube channel, and ninasoap.com, our blog. On our channel and on our blog, we share different ways to save money, different ways to make money to reach your financial independence, where you do not depend on an employer to provide for your family. And swing trading is one way to make money, just as small, one share at a time. Even with long option swing trading strategy, with one share, you can still make some profits. With some of those stocks, they were like $20 difference from one point to the other. Now all of them are over $1,000. Some of them are less than $100, and some of them are over $100. And this one is 169, for instance. From this point to where it is right now is $20, more than $20 difference. So if you buy one share and sell it at a new high and make $20 profit on that, it is a profit. Even if you make $1 profit, it's still a profit. It allows you to practice the strategy you are using, and you can just start one share at a time to spread your dollar, buying multiple stocks on your watch list to keep practicing the strategy you are using instead of having all your money in one stock. It can even be $200 per trade or $100 per trade, whichever is minimum and can afford one share of a stocks you are interested in buying and is high enough to meet the brokerage firm to open a brokerage account or a Roth IRA. Just start small and grow your account from there. If you buy a stock, it became negative, the price went down, just leave it alone and save money to buy another one. Just make sure you are picking stocks that you could have invest in long term, because they are good stocks. You see, we have Google there, for instance, and just start small. As a beginner, up a large cap would be a good one to start with, since it do not fluctuate much. You are not going to make a high profit in them, you are not going to lose your money in them, but they are stable enough for you to have time to practice the strategy you are using to see which one among those stocks work well with the strategy you are using. And you can set some profit targets or a new high to get out. If you are looking for ideas on how to create your own watch list, please check the video in the description for the playlist where we catalog videos on how to create your own watch list, and create your own watch list of a certain number of stocks you can analyze every day within an hour and swing trade from that list. At the end of the year, during the year, flag the one that doesn't work well for you, and at the end of the year you can take them out and go back to your long list, pull the one you didn't trade to replace those and give them a try. And over time you'll curate your watch list to be a watch list of stocks that work well with the strategy that you trade with, and that strategy you'll have time to customize it to your liking, to fit your personality type, your risk tolerance as well. If you have a full-time job, it's good to see if you are making enough to cover your household need, pay down some debt, and if you can afford to have a little bit saved to send to your brokerage account or Roth IRA and start swing trading a little by little, and learn to trade, to swing trade, so that you can learn the process, you can learn investment, and over time you can grow your account by adding more money and by accumulating profits. And over time, hopefully, profit generated from swing trading will be higher than how much you are making from your paycheck, and that is the goal. Trying to create multiple streams of income outside of your job. So you work hard to make money from your job, and you put that money to work for you, and the profits from that passive, semi-passive income, the profit from the money working for you, you use a portion of it to support your lifestyle, if that makes sense. Thank you. And within a certain playlist, we have some videos that if you find some questions that you have that we could have addressed in those videos, please check those playlists. We have not published all those videos yet, but they are recorded, and we have watch list videos series that we publish most of them, and we have another one in the making to just show you the whole process by using one stock in each video, so that when you come across a stock, you can use those filters or customize a little bit to put that stocks through to see that stocks is worth adding to your watch list. Thank you so much for your time.